Hey, everybody, welcome back to I always call it a podcast, so I'll say podcast, but I know it's a YouTube channel. We have an extra person on our panel today who is Donna Crone. She's with Retirement Wealth Advisors. She is a certified financial planner and a global financial planner. And the global financial planner aspect is how we actually met Donna at a conference in Mexico that we were at in early January. We got to talking, realized that Donna is as cool, more than likely you'll find out cooler through this video today, and had some just really good chats and kind of similar mentalities. And we also talked a lot about the Secure Act that was voted into law right about that same time, and thought, what an awesome way to get somebody great on our channel, learn a little bit more and provide some information to our clients and other viewers. And so, yeah, we'll jump into the Secure Act and talk more about
maybe Donna first, anything you want to add or subtract?
Just that it really speaks to how intensely geeky we are, because I do remember being at dinner in Mexico, having a very intense conversation about the Secure Act, and we were all very animated about it.
That was actually my anniversary dinner too.
Talking about what's that?
I said that was actually my anniversary dinner too.
That was your anniversary dinner. It was, yes. So yeah, but that was the topic of conversation, and I remember thinking, God, here we are in this beautiful, place in Mexico having this wonderful dinner, and, everyone's kind of relaxing, hanging out, and we're all like intensely like, let's talk about work, and really into it. So that was fun. It was fun.
You got to talk about some work. Otherwise, how do you deduct the trip?
Yeah.
Well, anyway, that trip, just for everybody watching, wasn't as cool in theory for Donna as it was for Steve, myself, and Ethan, who went on it, because we were going from 0 degrees to hot, and from Donna and her husband Jason, who we chat a lot with too, they were going from hot to hot. And so we got the benefit. Maybe you can tell by the surfboards and her photo in the background. She's based out of Florida, so she gets to stay warm year long.
Yes.
So just so you can be jealous, viewers, as we talk through this.
Yeah, that's why I have a sleeveless shirt on.
I'm wearing a vest.
And I'm wearing a sweatshirt. So we're trying to stay warm, and Donna's trying to stay cool. But yeah, maybe I think Steve's going to walk us through some of the topics we're going to hit, and then we'll hear from the real expert, and hopefully we have some good questions for her, so she can educate us even more.
Yeah. So as mentioned, we're going to talk about the Secure Act 2.0. It did, as was kind of mentioned, came out right before we went on this trip. It was all for the conference. There was a lot of learning going on, and so it just kind of was naturally a topic of conversation. So some high level kind of areas that we're going to go through. Our agenda here is kind of laid out nicely. Some things impacting all employers, and really includes the employees as well. And the next group of things is going to be really related to small employers and things that are encouraging them to kind of participate or establish retirement plans for their employees. The next area is provisions for the plan participants. As we were talking before this, and Donna kind of said that these are provisions that, okay, now you're in this. Now what types of things can you do or are possible or need to be aware of? And then we'll get into some college kind of loans and savings, and then maybe touch on a little bit of emergency type of savings and distributions as well too. So with that, I think we'll jump into that one that's kind of affecting all employers. And Donna, probably I think the first one that I thought of right away and was the mandatory participation. So maybe with that, I'll let you take it away with that topic.
Okay. So yes, the Secure Act 2.0. So as a lot of folks know, the original Secure Act went into effect in January of 2020. And now the Secure Act 2.0 passed December 29th, 2022. And with the first Secure Act, there was about a dozen significant changes to how we as Americans and we as employers prepare for retirement. With the Secure Act 2.0, there's about 100 changes. And one of the changes that has come about is this mandatory participation, right? But I have to clarify, because there's so many changes in the Secure Act 2.0, some of them have taken effect immediately, and some of them are rolling out over the next 3 years. So sometime between now and 2025. The mandatory participation is one of those provisions that's going to roll out effective pretty much, I mean, they say December 31st, 2024, but it's going to roll out really in 2025. And what this does is, and it's important to know who this applies to, right? Because this doesn't go to everybody. So if you're already participating in a 401k or 403b, any kind of retirement plan with your current employer, this is not going to apply for you. This is really for new plans going forward. So in order to qualify for this mandatory participation, the company has to have at least 10 employees, be in existence for 3 years, but the retirement plan has to be a new plan, right? Rolling out, effectively January of 2025. And what this mandatory provision requires is that the employer withhold or contribute 3% of an employee's salary into the company's retirement plan. And then that will go up subsequently about 1% a year until it reaches at least 10%. It could go as high as 15%. I think it's going to depend on your salary and what the plan, the specific retirement plan provisions are. But the underlying intention with all that is to get people to save for retirement, right? So as we were talking about earlier, is that there is this great dependency that's starting to happen in our country, or is happening in our country, of looking to the government, with Social Security and Medicare to take care of us as we retire. And that's a big shift, because Social Security was always meant to just be a supplement. And for many, many years, folks relied on pensions, and there was a time when you would go to work for a company and that's who you worked for your lifetime, or you got 20 years in or 30 years in with a company, and that's not the case anymore. In the 1980s, we started seeing that shift away from companies moving away from providing pensions and shifting the responsibility more onto the employees with 401ks and 403bs. And so that's where we find ourselves today. But I think overall, we're very uneducated about saving for retirement, what our options are for saving for retirement, and the impact that has. I don't think people fully realize the impact that has, saving for your own retirement. So the underlying intention with this provision is to get people to take responsibility and start funding or start working towards building their own retirement. But again, this doesn't apply to everybody. It's really only to new plans for smaller companies. Well, it doesn't really matter, as long as they have more than 10 employees, starting in 2025. I should mention too that employees will have the option to opt out of them. But like anything else, like we were talking about earlier, if you've ever had a subscription to something and then you kind of forget about it, it's a hassle to go find it, cancel it, figure it all out. That's kind of the same mentality that this is taking of, it's going to be a hassle to opt out of it, to take the time to notify your HR that you want to opt out. So a lot of people won't opt out, and they will by default end up funding their own retirement, which is exactly what the intention is.
Do you know the 10 employees, is that like 10 full-time employees, 10 eligible?
I'm going to say, I don't know. I don't know if it's just 10 employees. If it has to be 10 eligible employees. So here's the thing about that, Steve, that's really interesting. Like I said, there's over 100 changes. And what people don't realize is that they can pass this piece of legislation, but there are a lot of different entities or governing bodies that are affected by this, right? So you have, the Department of Labor, you have the IRS, just two right off the top, and they need time to kind of sort out the details around this. That's why this particular provision probably won't take effect until 2025, because we need to work that out. So some of those details, like defining what is 10 employees,
Right.
I don't
There
think.
will be
out
major interpretations, right?
What's that?
Because different interpretations of what the rules actually
Correct.
Congress actually pass and how they use their wording. It's not as cut and dry when the bill comes through.
Exactly.
It's the level interpretations, right?
Exactly. So that sounds very clear. If you have 10 employees or more, you're going to be subject to this mandatory provision. But wait a second, what do you define as an employee?
Mhm.
We're talking about retirement plans. Is it just those that are eligible to participate, or is it the whole company? Is it full-time? Is it part-time? Is it seasonal? Is it contract? Like, what does that even mean? And it just takes time, I think, to work those out. With this bill having so many changes, it is just going to take time for those interpretations, like you say, Aaron, to become a lot more clear than they are right now.
So
part of that even interpretation launches into kind of one of the other things under this mandatory participation and who can participate, impacting employers and the employees, because there's a provision in there changing what part-time and long-term employees eligibility requirements, which is way different than looking at a full-time equivalent, correct?
Correct. And what they've done is, again, remember the underlying intention is to get more people to participate in saving for their own retirement. So what the part-time provision in the Secure Act 2.0 is in regards to is it's lowered the bar for part-time employees to participate. It used to be that you had to work 1,000 hours a year and you had to be there for 3 years. Now they've lowered that down to 500 hours a year for the last 2 years. And if you work part-time, at least 500 hours a year, you will be able to participate in your employer's retirement plan now.
Yeah, which is essentially, what is that, 10 hours a week almost?
Yeah, basically, yeah.
Wow.
So just
They
like kind
lowered
of
the threshold for part-time employees to participate. There's still a time requirement in terms of you have to, if you're part-time, it's over the last 2 years. But the 500 hours over the last 2 years, but it is much, much lower than it has been previously. The previous mandates, even before the original Secure Act, made it almost impossible for part-time employees to participate.
Right.
So that's really shifted and changed now.
Mm-hmm. So how about, I know another piece of this is the Roth component, and a Roth 401k was already a thing. My understanding of that is the match. Is that correct? Is that the change here?
Yeah, the change is the change with the Roth. Okay, so under the 401k umbrella, you have a traditional side, which is tax deferred, and it's a tax deduction to the employee when they make their contribution. Then you have the Roth component, or the Roth side of your 401k, if your company offers it, which more and more companies are now, where you make an after-tax contribution, no tax deduction in the current year for it, but then it grows tax-free for the length of time it's in there, and then you can pull it out when necessary, and it would not be a taxable event in most cases. There are some exceptions, obviously. Mm-hmm. But just, overall, that's how they operate. So it used to be that if you wanted to make a catch-up contribution, now catch-up contributions apply to employees that are 50 or older. So they get to add a little bit more to their 401ks. And it used to be that you could only do that to the traditional side, to the tax deferred side of your 401k. What they've done now is said, you can now make that to the Roth side. So you can make that after tax. What they did on top of all of that is that they made the contribution to the Roth side mandatory, the catch-up contribution, if you make $145,000 or more. So if you're a higher income earner and you want to do the additional contribution, which right now is $6,500. So the max you can contribute to a 401k is $22,500. With the catch-up contribution, it's now $30,000, the additional $6,500. So you can, denote which side you want that to go to. But if you make $145,000 or more, it has to go to the Roth portion.
Why is that, do you think?
I think it is, I think the government honestly is trying to balance out the tax, right? So making a $30,000 contribution when you're a higher income earner can actually drop you into a lower tax bracket.
Right.
And so I think making that contribution after tax mandatory, if you make over 145, means that the government can get some of their money now.
Sure.
Yeah, I think that's what that is.
It was almost like they wanted to encourage the retirement contribution, but they didn't want to do it to the high earners. They didn't want to make it so obvious of a contribution to make to the high earners, but also didn't want to say they couldn't do it. They didn't want to put a limiting factor on people making a bunch of money. Like still put money in your retirement plan. We're just not going to give you the initial tax benefit of doing this. Correct.
You have to balance it out, so, the government, once you put that money into that Roth, that's it, that's your money. There's no more taxation on it, again, with some exceptions. But, provided you leave the money in there and you start drawing it out at retirement, you can do whatever you want. So I think the government is trying to balance out getting some of the tax revenue now versus, making that tax deferred for later. So, yeah.
There was one more area that I had a question on, and we're probably going over time on this topic, but I think this is one of the most interesting ones because of it's such an obvious thing, like you said, that they're trying so much to encourage people and to open up avenues for people to contribute to their retirement. There's also one that isn't maybe a big thing to talk about it, but one of the things they changed is they also provided incentives. To like employers can now provide financial incentives to have employees participate in these plans, which they weren't allowed to do before. My question goes to, they have some de minimis financial incentives. Any idea on what they're meaning? Essentially, that they're going to have a dollar amount, or that you can a max dollar amount you could probably use to incentivize. Any thoughts on how much that'll be?
I think that's one of those details that will also be worked out over time. My understanding, is that this would be like in the form of like a low dollar value gift card, right? So if you've ever worked for a bigger company, sometimes they'll offer financial incentives for you to do healthy things, right? So if you go get a physical, you walk 5 miles a day and you lose 10 pounds, you can get like $500, like a little financial incentive. I don't think the financial incentives will be that high, but I think it's the same idea where, hey, you open a 401k and you put in 1% more than what you're required to, we're going to give you a $100 gift card to your favorite restaurant. Same kind of theory of just, dangling the carrot a little bit to give people that incentive for some sort of immediate gratification of contributing to their retirement.
Cool.
But the actual amount, I don't know. Again, there's so many details that need to be worked out, and they're interdepartmental. They go across different agencies and entities. So I think it's just going to take time to work out the actual details on that.
Well, that's good because these departments are usually so quick. I know the speed.
Yes.
The speed of the IRS is so
It's unbelievable, isn't it?
Man, they put the Postal Service to rest on that. I shouldn't call these out if you work for the IRS or the Postal Service and you're watching this. We do love you. Please get back to us. But yeah, maybe kind of moving to the kind of the small employer, small business owners piece of this. I know there's some interesting things here. One we've taken advantage of, and maybe should have waited a year, could have taken even more advantage of it. But yeah, maybe talk, or maybe we should talk about the tax credits, but maybe kind of talk about the underlying theme again here. I think it's very similar, but I'll just shut up and let you talk.
Well, the underlying theme is to encourage people to save for retirement. And historically speaking, bigger companies have had more options that they can offer their employees than small employers or solo employers, right? Those one-man shows, that are out there, and there's a lot more of them. Probably over the last decade, especially with COVID, you see a lot of people have done that, or a lot of people have like a side gig, where they may work full time for another entity, a big company, but they're doing something on the side. And so the underlying intention with this is to get to that population and give them more opportunities and more incentives, again, to save for retirement. The big one, and I'm going to let you guys talk a little bit about the tax credits, but one of the big ones that I've taken advantage of this year with a couple of my clients is the extension on making a contribution for 2022 to a solo 401k. So in the big picture, normally how it works is that you have to make your contributions to a 401k, whether it's a solo 401k, a company 401k, it doesn't matter. You have to make those contributions by December 31st of that year. And if you make a big contribution on January 1st, it counts for the year that you're in. This year, 2023, they extended the deadline. So they're giving people the opportunity to open up these solo or these small 401ks, and they can go back and they can make those contributions now. The contributions have to be made. You guys may know better than I do. I believe they have to be made by April 17th this year.
I think it's the 18th. Yeah.
The 18th. Okay. So
we're getting an extra day. Yeah.
We're getting an extra day. So they have to be made by April 18th to count for 2022. But that can really reduce, especially if you have a small business or you have that side hustle going on. That's a way that you can tax defer some of that income by contributing to the 401k, a solo 401k. And again, that deadline is usually the 31st of the end of the year. This year, they've extended that with the passage of the Secure Act. So you have a few more weeks, to still get that done. And that could be a big tax saver for some folks, for real.
Yeah, and I really like that solo 401k. We have a fair amount of clients that, are in that type of, kind of solo gig that you're talking about. And when they're a higher income earner with that, that solo 401k is, cheap and easy to set up, and it's way better from a payroll tax standpoint than like a SEP, so
Yes.
That's usually the one that I recommend for people. So I like that they're able to do that. It helps them to get new clients in towards the end of the year and stuff too, that
Yeah.
they didn't know about it, so we can still implement it.
Yep. And like I said, that's a strategy I've been using with a few of my clients in a similar situation, whereby normally if we didn't make those contributions by the end of the year, you're kind of out of luck. But this year we have that extension and we've been able to do that. And it's been very, very helpful.
Did that solo 401k have to be established last year?
You can establish the 401k now.
Okay.
You have until the 18th to establish it and fund it.
Okay.
18th of 23 to establish
So
and
that
fund.
solo 401k is a little bit different than your traditional 401k, because that's usually by October of the current year. that you want?
Yeah, well, it's a, if it's a company plan, all the documents and everything have to be in place. You are correct by October. For a solo or an individual 401k, they are the same thing, by the way. They just go by different names depending on the institution that you're working with.
Mhm.
But the paperwork is much more simplified than like when you're doing a plan for a company, there's a lot of paperwork that has to go in place, like a contract agreement, how this is all going to work. For a solo or individual 401k, it's very simplified. So yes, normally it would have to be established by the end of the year and funded by the end of the year. But again, this year we got that extension of a couple of months to take advantage of that.
Okay, so we can have them, we can have employers or solo employers set it up today for 2022 and
Correct.
fund it.
Correct.
Much more like a SEP in that regard, because those you can set up.
Well, the one caveat with a solo 401k versus a SEP, well, there's two really. The first is a SEP is only funded by the company, right? By the entity.
Yep.
Whereby a 401k primarily is funded by the employee or the owner. So you do have to run payroll. That's like kind of the caveat there, right? So if you're not accustomed to running payroll, I do this with clients, and the payroll piece of it can be very overwhelming to them. I'm like, it doesn't have to be. We just run it through payroll. Sometimes we only do it once a quarter, or we do one big one at the end of the year. And we fund the 401k for the year, usually in the beginning of December. And that way it runs through payroll, and then the company can make the matching contribution, whatever they're going to do. But your limits are much higher, or can be much higher, on a solo or individual 401k than they can be for a SEP. And you get to kind of take advantage of both sides in that your company, most people who have a side hustle or a small business, it's passed through taxation, right? They're an LLC or an S Corp, and it's passing through their personal taxes. So anything the company does is going to be deducted before it comes to their personal taxes. But then whatever they do on their payroll gets taken off their personal taxes. So they have kind of like this dual effect on reducing their tax liability.
Yeah. How you describe it is typically how we run payroll for our clients in that situation, to either quarterly or one large one at the end of the year. I could even see though now for like a new client, because we can get the penalties abated the first time. So even somebody coming in now, if they're a high income earner, it's the beginning of March, we could still probably run a late payroll, pay the payroll taxes. They pay some interest on that, but if we got the penalties abated, I could still see there could be a significant tax savings there. So yeah. Okay. Credits?
You guys might be a little bit more familiar or understand how the tax credits work a little bit better than I do. My understanding of it is that some of the administrative fees, they've upped the percentage on the administrative fees to 100%. So if you have 50 employees or less, you can take whatever it cost you to establish a 401k. Most times it's around $1,000 or $2,000, the administrative piece of it, but you can take that as a tax credit. And my understanding is dollar for dollar. So you can take that, if it costs you $2,000, it's $2,000 in tax credits that you're going to get for that. That's my understanding of it, but because I'm not a CPA, I don't see how that actually works on paper the way you guys would.
Yeah, and so the real change was they pretty much just jumped it from 50% to 100%.
To 100, yeah.
The other provision is being up to like a max of 1,000 per employee.
That's on employer contributions for that employee, right?
Correct. Yes. Yes.
Yeah.
So yeah, it is a great credit. I mean, one of the difficult things when you talk about 401k plans or solo Ks, they are more expensive than setting up a SEP or even a simple. But the tricky part is trying to also tell people, but it's the most beneficial,
right?
And then also that being careful that if you go the less expensive route because it's simpler and easier to set up, eventually, if you want to make the change to a 401k plan, you have to be you get a little handcuffed by when you can start it, when you can start funding it. And so it really seems always the most beneficial to attack the 401k right away. And these incentives just provide for it not being a more expensive plan and really getting to jump in and take advantage of what can be the best plan for people.
Yeah, honestly, I would not list the cost of or the administrative costs associated with 401ks as being a barrier to starting one. I don't, that's not what I see in my practice. It's not, the benefits do far outweigh them. One of the other things that I do a lot of is I roll over SEPs into 401ks. So, but you're right, you got to be careful with the timing of that. So even if you do have a SEP in existence now, or a SEP is a better option for you, yes, you could definitely open up a 401k down the road, but you would need some guidance just to make sure that you don't end up funding both in the same year and get yourself into trouble with that. So yeah, that's something you do want to avoid.
But so, I mean, with the credits, so in theory, if you had 10 employees in the plan,
Mm-hmm.
I mean, that first year could be a $15,000 credit that you would receive.
Yeah, between the up to 5,000 for the admin fees and then $1,000 per employee. Yes.
Right. So
again, tax credits, dollar for dollar. So yeah, again, you think about the underlying intention of this is to encourage people to save for retirement. And in this case, encourage employers to provide those options to their employees. So they're going to incentivize as much as possible to do so.
Right. And I mean, in that example, right? I mean, so as the owner, I mean, how many years of, administrative expenses did that just cover with those credits that I received? And I got them up front, right?
Yeah.
And I get the deduction still down the road when I do incur those expenses. So
yeah, it's a good deal. It's definitely a good deal.
Yeah.
For sure.
Well, should we move to provisions?
Yeah, this is actually my favorite part.
All right.
Yeah, this is my favorite part because, okay, so, we're humans, right? We're selfish. We want to know what's in it for me, right? So we've been talking a lot about employers, but as an individual, like, what does this mean to me? How does this change my life? So that's why I think I like this area so much.